So as expected, the market turbulence at the start of the year has slowed down growth in the developed world, but without risking sending it into recession. Now things have calmed, financial conditions have eased, we should see things pick up again in the coming months. Look at the US, the economy there is doing fine. Labour markets continue to improve and the underlying inflation rate is beginning to edge higher. Now the Fed seems to have become more focused on the downside risks, and so we're reducing our expectation this year for 2 rate hikes rather than the previous 3. Outside the US, it's probably China that's most interesting. The economy there has responded nicely to the monetary and fiscal stimulus, but we are a little worried that the growth is being bought at the price of a further expansion of the credit bubble. So it's not ideal, but it means that for the next 6 months or so, we don't have to worry about growth in China. So where are we left? Similar to the last 6 or 7 years, there are plenty of uncertainties in the world without anything being too critical. Growth overall is adequate, but without being particularly impressive.
Our May monthly investment guide deals with the question, should you sell in May and go away? Looking at how US markets performed between the period of May and September each year since 1985, the S&P 500 delivered positive returns in 20 out of the 31 years. In other words, investors who have made money 65% of the time staying invested from May to September. However, there were 11 years that the S&P 500 corrected during the summer months. In those years, the stock market decline was mostly preceded by strong gains from January to April, with the exception of 4 years when the January to April weakness was carried into the summer months. Those years were recession years. Therefore, there's not a convincing case for investors to sell in May and go away, especially if 2016 is not going to be a recession year. More importantly, we think that macro factors will matter more than seasonality like sell in May. The recession scare in early 2016 has proven to be a false alarm. The rebound in US and Chinese manufacturing surveys confirm that underlying economic conditions are resilient. Global economic activity is on track to improve. The outlook for Asian equities is becoming better as we are seeing a policy-induced cyclical rebound in China. Therefore, we remain confident and comfortable with our overweight call on Asian equities. At some point, market volatility will return. The current risk rally will likely appreciate at a more modest pace compared to the past 2 months, with periodic setbacks and heightened volatility. In particular, the upturn in US inflation and the view that the Fed hiking cycle will be steeper than is currently discounted are not yet on investors' radar screen. Furthermore, political risk appears to be growing with Brexit and US presidential elections. Assessing the balance of risk and reward, we make no changes to our tactical asset allocation course. We maintain our overweight call on equity and emerging market high-yield bonds, which we think will benefit from the broadly benign environment.